Hi everyone, it's Caitlin and welcome back to your financial journey. So throughout history, financial markets have been driven by cycles of boom and bust. Stock prices rise, fortunes are made, and then, suddenly, the market collapses. Some of these crashes wipe out billions in wealth in a matter of days. Others trigger global recessions, mass layoffs, and economic hardships for millions. Yet, through the ashes of these financial disasters, new companies emerge. Some of the biggest names in business today, like Tesla, Facebook, and Uber, were founded during or shortly after major economic downturns. Drop a comment below. What other well-known companies do you know of that were founded during or shortly after a recession? In any case, today we'll be exploring 5 of the worst stock market crashes in history. We'll break down what caused them, which major companies went bankrupt, and which legendary businesses were born from the wreckage. The Wall Street crash of 1929. The Great Depression begins. The first and most infamous stock market crash in history is the Wall Street crash of 1929, which led to the Great Depression, the longest and most severe economic crisis of the 20th century. The 1920s, known as the Roaring Twenties, was a period of rapid economic growth. The stock market was booming and people were eager to invest. But many were doing so using margin trading, meaning they were borrowing money to buy stocks, expecting prices to keep rising indefinitely. This created a huge financial bubble where stock prices had become completely disconnected from the actual value of the businesses they represented. By the summer of 1929, warning signs were everywhere. Industrial production was declining, unemployment was rising, and agricultural prices were falling. But investors ignored these warnings, convinced the market would keep going up. Then, in October 1929, reality hit. On October 24th, 1929, Black Thursday, panic selling began. Stock prices plummeted as investors rushed to sell their shares. Then, on October 29th, Black Tuesday, the market lost 12% of its value in a single day. Over the next 3 years, the Dow Jones Industrial Average fell nearly 90% from its peak. The Great Depression followed, lasting for more than a decade. Unemployment in the U.S. skyrocketed to 25%. Wages plummeted and businesses collapsed. People lost their savings as banks failed, and millions were left struggling to survive, with no jobs to sustain themselves or their families, and no savings to fall back on. Not even major corporations were safe. The Bank of the United States, one of the largest banks in America at the time, failed in 1931, triggering a wave of bank runs, where depositors rushed to withdraw their money before their bank collapsed. Similarly, Kruger and Toll, a massive Swedish investment company run by Ivar Kruger, who was known as the Match King, collapsed under the weight of financial fraud and enormous debt in 1932, in the event dubbed the Kruger Crash. Finally, the Chicago, Milwaukee, St. Paul, and Pacific Railroad, still known as the Milwaukee Road, declared bankruptcy in 1925. One of the largest railroad companies in the U.S., the economic downturn destroyed freight demand, causing the company to fail. On a more positive note, as the economy started to recover, other opportunities surfaced and new companies were born. In 1934, United Technologies was founded. It started as an aerospace and industrial manufacturer and later became a major player in aviation and defense. Publix began as a small grocery store in Florida in 1930 and grew into one of the largest supermarket chains in America. Our first encounter with Publix was on our family road trip down to Orlando during the pandemic, and I love Publix. You can find almost anything there. But my favorite probably is Polaroid. Polaroid was founded in 1937, pioneering instant photography and changing how people captured and shared memories forever. The stock market took 25 years to fully recover, finally returning to its 1929 highs for good in 1954. Despite various economic reforms under FDR, it really took World War II, which ramped up industrial production and created millions of jobs, to bring the economy back to its pre-depression highs again. Black Monday, the 1987 market meltdown. Fast forward nearly 60 years to another catastrophic one-day market crash. Black Monday, October 19, 1987. This crash was different from 1929, though. Instead of happening over months, the Dow Jones Industrial Average, one of the most widely recognized stock market indexes, collapsed by 22.6% in a single day, the worst one-day percentage drop in history. What caused it? A combination of computerized program trading, rising interest rates, and investor panic. By 1987, trading algorithms had become more common, allowing computers to automatically sell stocks when prices dropped past a certain point. But instead of stopping losses, these automated sell-offs made the crash much worse, triggering a downward spiral that no one could stop. As the economy reeled from the devastation of Black Monday in 1987, financial institutions and businesses across industries struggled to stay afloat. Lomas Financial Corporation, a major mortgage lender, was burdened with bad loans and plummeting asset values. By 1989, Lomas was unable to recover and collapsed into bankruptcy. Similarly, First Republic Bank of Texas, one of the largest regional banks in Texas, found itself trapped in a web of economic instability. In 1988, First Republic was declared insolvent and taken over by regulators. But on a more optimistic note, the market downturn and recovery period again paved the way for new companies to rise. In 1984, Dell Technologies had started as a small PC business, but following the crash, it rapidly expanded, offering affordable, customizable personal computers directly to consumers. And Cisco Systems, founded in 1984, capitalized on the growing need for networking technology, changing the infrastructure for computer networking and the early internet. Unlike the 1929 crash, the stock market recovered in just 2 years, with the Federal Reserve stepping in to stabilize the economy. The dot-com bubble burst of 2000 to 2002. By the late 1990s, the rise of the internet led to a massive tech stock boom. Investors poured money into anything with .com in its name, even if the company had no profit or even revenue. At its peak, the Nasdaq Composite Index had surged over 500% between 1995 and 2000. But in March 2000, the dot-com bubble burst. Within 2 years, the Nasdaq lost nearly 78% of its value. As the dot-com bubble burst, overhyped internet startups collapsed. Pets.com, one of the most infamous dot-com failures, known for its massive ad spending and weak business model, burned through cash and failed in 2000. Similarly, Webvan, an ambitious online grocery delivery service, expanded too fast and ran out of money in 2001. Yet, from the wreckage, new tech giants emerged. In 2003, Tesla kickstarted the electric vehicle revolution, disrupting the auto industry. A year later, Facebook redefined social networking, growing into the world's largest platform over time, while LinkedIn transformed professional networking, using the internet to change how businesses and employees connect. While the overall stock market had recovered by 2006, the tech sector took much longer. The Nasdaq didn't return to its 2000 highs until 2015. The 2008 financial crisis, the Great Recession. The 2008 financial crisis is considered the worst economic disaster since the Great Depression. Unlike previous crashes, which were mostly driven by stock market speculation, this one started with the housing market. In the early 2000s, banks were giving out home loans to almost anyone, even if they had no stable income or poor credit scores. These high-risk loans, known as subprime mortgages, were then bundled into financial products called mortgage-backed securities, or MBS, and sold to investors, including major banks and hedge funds. At first, everything seemed fine. Housing prices kept rising and investors were making money. But in 2007, cracks started to appear. Homeowners began defaulting on their loans, and suddenly, banks were stuck with massive amounts of bad debt. Then, in September 2008, everything came crashing down. Lehman Brothers, a 158-year-old investment bank, collapsed under the weight of bad mortgage debt, filing for the largest bankruptcy in U.S. history with $600 billion in assets. This triggered a global financial meltdown, sending stock markets into freefall. The S&P 500 dropped by 57%, and the crisis wiped out over $10 trillion in wealth. The government responded with massive bailouts and stimulus packages, injecting hundreds of billions of dollars into banks to stabilize the financial system. The Federal Reserve cut interest rates to near zero, helping fuel a long recovery. The 2008 financial crisis almost brought Wall Street to its knees. It wasn't just Lehman. The same year in 2008, Washington Mutual failed with $300 billion in assets, the largest commercial bank failure in U.S. history. However, it was later seized and sold to JP Morgan Chase, transferring substantially all of its assets. As the economy rebuilt, innovation thrived. In 2009, Uber transformed transportation, making ride-sharing a global norm, and WhatsApp became the go-to messaging app, later snapped up by Facebook for $19 billion. Meanwhile, Airbnb revolutionized travel and hospitality, letting homeowners rent their spaces and challenging the traditional hotel industry in a way that we still use today. By 2013, the stock market had fully recovered, but the effects of the crisis lingered for years. Millions of Americans lost their homes and jobs, and the wealth gap widened significantly. The COVID-19 crash of 2020, the fastest market drop in history. The most recent crash on our list is the COVID-19 market crash of 2020. Unlike other financial crises, this one wasn't caused by bad loans, speculative bubbles, or algorithmic trading. Instead, it was caused by a global pandemic that shut down entire economies overnight. In March 2020, as COVID-19 spread rapidly across the world, governments imposed lockdowns, travel bans, and business closures. The stock market reacted with sheer panic. In just over a month, the Dow Jones lost 34%, marking the fastest decline in stock market history. The COVID-19 lockdowns of 2020 especially crushed industries reliant on retail, travel, and live entertainment, all of which were severely restricted during the pandemic. JCPenney, once a dominant retailer, finally collapsed after years of declining sales. Hertz, a car rental giant, went bankrupt as travel demand vanished. Cirque du Soleil, a circus entertainment firm famed for its spectacular performances, folded after global event cancellations wiped out revenue. Yet, as before, some new and old businesses thrived in the digital shift. Nobody knew Zoom before the pandemic, for example. It was founded in 2011, but exploded post-2020, as it became essential for remote work, education, and communication, cementing itself as a leader in video conferencing worldwide. And for those of you who know my mom and her business, that was the time when Diamond Nest Egg went live on YouTube as well. Unlike past crashes, though, the recovery from the COVID-19 crash was one of the fastest in history. The Federal Reserve cut interest rates to zero, launched trillions of dollars in stimulus, and bailed out businesses and individuals. And, of course, the lockdowns were eventually lifted. By August 2020, the stock market had fully recovered, and by 2021, it reached new all-time highs. Final thoughts. What can we learn from these crashes? Looking back at these 5 major crashes, there are some key lessons investors can take away. First, markets always recover, but timing varies. Some crashes took decades to recover, such as the Great Depression of 1929, while others rebounded in months, like in 2020. The important thing is to be aware that things will get better. Second, don't panic. Panic selling often makes losses worse. Investors who sold during these crashes often missed the recoveries, so be mindful about selling before you're sure. And third, great companies are often born in bad times. History shows that some of the world's biggest businesses started in recessions. No matter how bad the crash, the market has always bounced back. The best strategy is to stay informed, keep your patience, and invest wisely. How are you feeling about markets and investing right now? Leave a comment below and let us know. As always, don't forget to like and subscribe if you enjoyed today's video. And make sure to check out this fun one here that my sister Ava did on Warren Buffett and how he built his empire. Thanks for watching, and we'll see you again next time.